The second potential market mover is actually just 58 minutes away. Three major names in the AI hyperscaler build-out are about to report earnings. CoreWeave, which rents out massive clusters of data center chips, Supermicro, which makes data center server racks and cooling systems, and Lumentum, which supplies cloud and networking equipment, all report earnings after the bell. Any misses or beats could set the tone for tech stocks, which could underscore the power of AI to lift or lower the entire stock market. Are you too over or underexposed to the AI hyperscaler sector right now? Are you asking yourself that? Well, let's head right to the floor show, because joining me now, JPMorgan Asset Management, multi-asset solutions global strategist David Lebovitz is here. I don't know, to answer that question, are people too overexposed or underexposed as it pertains to how these stocks have been moving?
So I think that there is a healthy amount of exposure to these names in the market. And what I mean by that is you have sufficient and in some cases extended exposure amongst the retail community, but the fundamentals are very supportive of taking that risk. If we were in an environment where the earnings weren't materializing and people owned these businesses with the scale that they do today, we would be more concerned. But actually, one of the things that's happened here over the past couple of weeks is the market capitalization of the hyperscalers and their earnings contribution to the overall index earnings number have come back into balance. And so if you do have a fair amount of exposure to these, for us, it's not terribly concerning because, again, the fundamentals are there and are supportive.
Let's show people some of the fundamentals. We put together the earnings beats and the numbers for hyperscalers in the most recent quarter. Look at Microsoft, up 23%. That looks great, sure. Meta, up 13%. Google, Alphabet, up 294% year over year. Amazon's second quarter earnings up 242%. That makes you comfortable enough to tell clients it's okay to add to your positions, but would you wait till there are slight pullbacks?
So I think what's important to remember with equities is it's not level that matters, it's rate of change. And so when you see these growth rates that are quite robust, there is room for disappointment if the growth rate were to slow. We don't expect earnings growth to slow materially anytime soon. I think that those 200-300% numbers will normalize, but I think that that's already in the price. But I do think that there will be an opportunity to add more to these names if there is a disappointment on earnings at some point down the road. The important thing that I would highlight, though, is that from a valuation perspective, right, valuations have actually gotten quite cheaper over the past couple of months. And so you're no longer paying a premium for this earnings growth the way that you were earlier in the year. That said, there may be a better entry point than
you actually had a good call, and we could show the markets since, I guess, year to date, and you can see the move in them. And it was back in February. You were right here on this show. And you basically said that you were pro-risk, although the rub was in the valuations, which back then were a little too high. But you said buy on the dips and stay exposed to the market. And you can see what stocks have done since then. The S&P, the Dow, the NASDAQ, all up year to date in a pretty significant way. And therefore, it was a correct call. What would give you pause? What would make you change your risk assessment?
So the biggest thing that I've been watching is kind of how credit markets are behaving relative to equity markets, because one of the things that's happened as part of this AI trade is you've seen a lot of these businesses issue a fair amount of debt either in the investment grade market. You've seen some others issue in the high yield market. We know about the special purpose vehicles and the off-balance sheet financing. What I'm watching for is when indigestion in credit markets begins to manifest itself as indigestion in the equity market. We're not there yet. I mean, spreads have been widening on hyperscaler debt, but they're still at fairly reasonable levels compared to, cost of financing relative to the size of the business. But if you begin to see spreads widen further, if you begin to see new issues not be taken down with the same amount of demand, that would give me a little bit of pause, especially if it shows up in equity weakness. And so for us right now, it's about balancing these two things in portfolios. We can get healthy streams of income from credit. Clearly, there are some cracks forming. At the same time, equities are rich, and so we need to be careful there as well.
I mean, the U.S. markets look great, but your title is global strategist. Where else on the globe do you see opportunity?
So for us, it's really a question of how do we build different exposures to this technology theme? So the U.S. is probably the best way of doing it. I don't think anybody would disagree. Emerging markets are another place, and I would add Japan in there as well. So kind of the Asia-Pacific region, another way to play that technology theme. Europe, we're being much more selective. That's not really a beta trade from where we sit. But between the U.S. and EM, we think that we are building an interesting risk profile in the portfolio. We're buying some stuff that's cheaper. We're buying some stuff that's high quality. And when you mix it it all together, you still get that exposure to the tech story, which we believe continues to have legs.
There are a lot of Japan ETFs, and we've been showing them on the screen. There's a small cap ETF. You know, if you really want to get sort of on the margins and on the edge of looking at a little more risk, but does nothing give you pause about the fact that Treasury just recently intervened to prop up the yen?
So for us, the Japan story is much more of a structural story. And, yes, we need to watch what happens with the currency going forward. But I think given the way the central bank reaction functions are evolving, we'll probably see some stability in the yen going forward. For us, this is more about the fact that, the Japanese economy is generating nominal growth, positive nominal growth for the first time in decades. You're seeing corporate governance reform. You're seeing more shareholder-friendly behavior. You put all of this together, and then you look at the valuation. And for us, it's a really interesting place to play, and frankly, to our mind, it has more upside than a market like Europe.
I know we often hit the negative side because I started in local news and we're always looking for the worst side of everything. But that said, NVIDIA just made this huge announcement with some of the biggest of the big on Wall Street: BlackRock, Blackstone. You had Goldman Sachs, all these names coming together for a $500 billion fund that they would put together to be involved in NVIDIA chips, because NVIDIA chips are at the moment best in class when it comes to these data centers. Well, StockTwits just posted, and they said that Wall Street just handed NVIDIA the biggest credit card in history. When people have a big credit card, sometimes they abuse it. I'm not saying Jensen Huang is, platinum standard, but you have Intel now. Yesterday it was $15 billion, and now they're floating a $20 billion stock offering because they need to get that money. Google has done the same thing. Anything worry you about that?
So the thing that strikes me is there is just a lot of money churning through the economy right now. And if you look back to the internet period in the late 90s, you go back to the Industrial Revolution. I mean, there are countless examples of when we have these big investment booms, the quantity of money that ends up being spent. And so the numbers in and of themselves don't necessarily concern me, because at the end of the day, if the return on that investment is there, then the capital structure is helpful in getting you to that end result. What would make me nervous is if we saw this money used for less productive purposes, or purposes that are not necessarily clear. And then furthermore, when, say, the hyperscalers do report, you're not seeing that return on investment begin to materialize, particularly through the cloud businesses. And so, if it becomes spending for the sake of spending, that's going to make us a little bit nervous. But right now, it seems like there is a real use case here. And when you look at the estimates of what's needed from a compute perspective, there's clearly more work that needs to be done to get to where we want to be.
I remember the dot-com era. DoubleClick had the chocolate party. They were spending a lot of money on big parties, and where were the earnings? Great to see you, David. Thanks you so much. David Lebovitz.